Hello there, this is my first clip pertaining to Chapter 18 in your textbook. And in particular, pages 598 to 600, what I'm calling fractional reserve banking. Okay? And this is basically the method, if you like, of how money is actually created. I'm sort of actually combining two concepts here. They're so sort of interrelated that I don't think it's necessary to try to pull them apart. This, as I said, fractional reserve banking, which just means that banks only keep a fraction of their deposits as reserves. That's what's called fractional reserve. So they don't have 100% reserve ratios here. And this other concept, which your textbook does talk about, called open market operations, which is just basically the question of what happens when the Bank of Canada, the central bank, purchases a bond from a private individual. And these two things are so, as I said, so intertwined, interconnected, that there's really no reason to separate them. So I think this clip series will probably be longer than 10 minutes, just because there's a lot of stuff to cover here. So what I wanted to do is sort of, first, let's see my list of things I want to cover here. The players. This is basically, we have a situation where we're living in a world where we have sort of three major players, at least initially. We can actually have more players, but there's sort of three big ones. The first one is the central bank. This is the Bank of Canada. So that's one player. The second player is some individual, like me, or just some private citizen who happens to own some bonds. And the third player is going to be a private commercial bank. And then eventually what happens is we bring in some of the other commercial banks, so like player 4, player 5, and player 6 will be additional private banks that come along later on. Okay, so those are our three key players. So now what I want to do is I want to talk about some of the key terms, just so we keep everything straight. I'm just gonna, 1 second here. Okay, I'm back. I just had this sort of idea. I wanted to show you something. So I found it in this book called Fortune, Guide to Investing in the 90s. It just sort of kind of clicked in my mind. Because I wanted to make sure you grasp all these key terms. And the key terms that I want to cover are currency, reserves, deposits, reserve ratio, and sort of this cash ratio, if you will. And what are bonds? What exactly is a bond? Because depending on what I think I can see how this could be confusing. Is that from whatever perspective you look at this, from one perspective it could be an asset, from another perspective it could be a liability. Okay, so let's go through these key terms. Let's talk about bonds, because this is really the crux of it. I keep using that term, bonds, bonds, bonds. So what does it mean? Right, it's not James Bonds, James Bond. It's financial bonds. Ultimately, what a bond is usually, millions or billions of dollars. when a company, usually like a large company or a government, and governments are big in this area, want to borrow, billions of dollars. And so what the borrower does is they write up a piece of paper called a bond certificate. Okay? And they give this to the investor. And the investor then gives the money to the company, or gives the money to the government, which then the government or the company goes and spends. That's why they're borrowing. And then what happens is that, it could be annually or every 6 months, depending upon the terms of the contract, because that's what basically this is. This is basically contract law in the sky. It's bonds, it's contract. The borrower, the government or that big company, then makes these sort of coupon payments. They're basically interest payments to the investor. So I want to show you this from this book again. It's called Fortune Guide to Investing. To show you, this is an example of what a bond looks like. So maybe it'll help you. This is actually an example from Pepsi. Okay, so it's a specimen. Like, it's not an actual real bond, as in someone's name on it, but this is what it looks like. I just want to get this in here. See, it says it's from Pepsi. See? And that's all a bond is. It's like a piece of paper, right? It's just a piece of paper. Has a picture of it looks like some sort of woman on the top. And by the logo there. And on it states the interest rate, the maturity date, the par value, and so on. And that's all a bond is. It's a piece of paper with some fancy, got all the fancy little, designs on it, so it looks pretty. But I mean, that's all it is. It's a promise to pay, right? That's what we're saying. The government or the corporation that's borrowing, the one that's borrowing money, is making a promise, and what they are promising to do is to pay the investor these coupon payments, these interest payments, basically what they are, usually every 6 months, so every half a year. And there's also another promise at the end of all of this, which might be like 30 years from now, when the bond matures. The borrower promises to pay the investor the initial principal amount back. They call that the face value of the bond, which are usually like some multiple of 1,000 is normally how it's done. And of course, these can be for very large amounts. We're talking billions and billions of dollars. So for a Canadian government could just borrow like that. So and possibly even to trillions of dollars, I suppose. Anyways, it's a big, these are not like you're borrowing $50 kind of things. These are like big borrowing type deals. Is what I'm trying to say. So that's what a bond is. So that's what I talk about, buying bonds. What you're literally doing is you're buying this piece of paper with a picture of a woman on it and some fancy, squiggly lines on it, so it looks all pretty. The buyer of the bond gives money to the borrower, and the borrower gets the money, and then the borrower is the one who has to make all the payments back. So this concludes the first clip. I'm going to come back, because now my 10 minutes is almost up, and finish defining all the terms, and then explain how this sort of fractional reserve banking open market operations scheme all works.